Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we welcome you so warmly to another Barometer Readings webcast. Joining us today, as always, will be our Chief Investment Officer, David Burrows, and alongside David will be one of our key analysts on our trading desk, Amit Joshi. Amit, welcome to the program. David, we've got lots to discuss, I'm sure. And of course, at the tail end of the conversation, we will be pleased to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up with a question on the Q&A or the chat on the Zoom app. And with that, I turn this conversation over to the one and only David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Great, thanks. Great to be here and looking forward to this update.
Great. Well, we're headed into the heart of the fall. We're into the second week of September, and this is a time when people get a little bit nervous. Lots of stuff to talk about. We'll make some observations on what we see going on in market internals and some of the leadership, and just address, I think, some of the questions that are out there. It's a time, not to press too hard from a calendar perspective, but at the same time, markets have been repairing themselves slowly since last October, almost a year now. And we are making some progress. There's some leadership in the market, and there's certainly some weak spots. And I think you really have to pick your spots. So with that, let me just run through sort of from a high level, kind of what we're seeing. We always find that markets tend to behave in the fall the way that they come in from a technical perspective. So we always want to look at the big picture first. Just a cursory view, we continue to be in a structural bull market that started in 2013. There is nothing to indicate that we are into a period like 2000 through 2013, where we had 250% declines in 2001, 2, and 3, and 2007, 8, 9. It's nothing at this point like what we saw between 1966 and 82, which was a series of very difficult declines and cyclical rallies. So far, it appears that this most recent correction bear market has been sort of a cyclical bear market, and markets are preparing to move on. We break things up in different ways, and everybody looks at things differently. I think this is an interesting chart from RBC that looks at the concept of structural or secular bear markets and bull markets, and the different types of leadership that you've had going through them. And it's interesting. Their view is that we are in a reflationary environment. It's been our view now for well over a year. And certainly the reflationary market that happened after the Second World War was a period of rising interest rates and a period of rising stock markets, and in particular, parts of the market that were particularly economically sensitive, and dividend growth led the way. That has been a characteristic of this market. And that has not changed. This is the most recent bear market, cyclical bear market. We'll talk about that a little bit. From an S&P perspective, this is the bull market of the 80s and 90s. Lots of time and price corrections along the way, but nothing like sort of a 2001 through 3 bear market or 2007 through 2009. And this most recent bear market we've been in, we're still about 6% off the highs. It's been about 21 months, which feels like a long time. The low was October the 6th. At that point, the market was down just about exactly 25% from the highs. And the market has slowly been climbing a wall of worry ever since. Now, a year ago, there was 100%, almost 100% expectation of a recession. 98% of economists were expecting recessions. The number's a little bit lower today. But certainly, we've been through a tough bear market. Now, this is a hallmark of a regular market. We've looked at these statistics before, but about once every 2.7 years, you can expect a 20% plus bear market. But it also means you shouldn't expect another one, right after it. So we did see a 20% plus bear market in 2018. We saw a tough, quick decline and recovery in 2020. You had a 25% bear market in 2022. All of that stuff is fresh in our minds. And so every time we see 3 or 5% pullbacks, people are afraid that it's going to turn into something more. And we certainly are watching, but it's not that likely. When we look at the history of markets, we know in gray there are regular bear markets. They tend to be relatively short-lived, and what comes after them is significant in years and in percentage point moves. Now, in structural bear markets, the rallies are shorter, like 1966 through 1982. The bear markets were longer and the rallies were shorter. But in bull markets, like in the 80s, much longer rallies, much shorter bear markets. So we think we started a structural bull market in 2013. We had a great rally to 2018, short bear market. And really since 2018 through 22, absent the small COVID sell-off, market pretty good. We've been through this bear market and we're in the very early stages of the next leg. So unless something changes dramatically, we think we're still in the very early stages of a new economic cycle, and more importantly, a new market cycle. We have to keep in mind that market cycles tend to get going before the economic cycle does. And we've been through a very tough Fed tightening cycle that freaked out a lot of people, made people very nervous, and for good reason. There's a lot of debt in the economy. Companies with debt and have funding requirements are probably going to have a tougher time than companies that generate cash. If we look at the S&P 500, it's a group of companies that largely are well-funded, companies that mostly generate cash. And you can see that since October of 2022, we've been putting in a series of higher lows, and that continues. We pulled back through the month of August, sort of right back to the trend that's been in place since the lows in October of 2022. And at this point, this trend line is holding. Now, as I mentioned, we're in a tougher time of the year, so we're watching. We look at the NASDAQ 100, which had a very sharp rally through the spring of this year. It also corrected in the month of August, but rallied, broke trend, and now we're retesting the top of this little downtrend from August. But again, a series of higher lows and higher highs, and all the moving averages working their way higher. We currently are sitting just above the 50-day moving average. And so again, at an index level, things are slowly improving. The TSX has been less positive. It's really only up about 3% on the year, but we also have a series of higher lows that supports the fact that probably last October was the cyclical low. So we've talked a little bit about the fact that global markets have performed quite well over the last number of months, and that continues. The Nikkei, which is the most unusual leader for the world's markets, continues to lead. And this is a market that struggled with a lack of inflation for 30 years. And a little bit of inflation is being seen as a very positive thing. So a lot of industrial companies in Japan that are benefiting from manufacturing growth around the world, and the market performing well. This has become a favorite market for Warren Buffett. The Indian market also doing quite well, post a contraction that took place during the Fed's and the global central bankers tightening cycle. Markets have been rallying over the last 6-8 weeks, and very close to making new highs. So when we get to fixed income, we've been pretty bearish. And the reason for that is after a series of lower lows and lower highs in rates, which was a bull market in bonds, we saw a significant reversal in rates in 2020. And there's no sign that that's over. The sell-off in the aggregate bond index has been going on since the spring of 2020. We made a low when the market made its low in October of last year. Bonds rallied a little. A lot of money flowed into bonds looking for a safe place to hide, and they've been working their way lower over the course of 2023. When we look at the TLT, which is the long end of the US bond market, it's a similar picture. All of the moving averages continue to move lower in price, which means bond prices are falling. At the worst point, the TLT was down 48% from the highs, a tough pill to swallow for a bond investor. And when we look at last year, while we know stocks were down about 24% at the worst point, bonds were down worse, down 30%. So it's an unusual time because I can't point to another time since 1787 where bonds were down 3 years in a row. But that's the case as it is today. So bonds are in a bear market. They could reverse at some point and have a cyclical rally. We watch for that. But at this point, we think stocks are more constructive than bonds. However, positioning continues to be quite crowded in bonds and cash. So we see over the course of the year, sharp inflows into cash and bonds, very little by way of flows into equities, yet equities are outperforming. So we think positioning is probably offside here. When we look at a simple chart that relates stocks, or this S&P versus bonds, the TLT, you can see that all through even 2022's bear market, stocks were outperforming bonds. And that continues to today. When we compare dividend growth, the RDVY ETF, to the aggregate bond index, post the Fed tightening cycle, dividend growth has started to outperform bonds. So for many of those who've been watching this webcast on a regular basis, our belief is in a rising rate world, which we think we could be in for the next several years in fits and starts, dividend growth is a more attractive strategy than fixed income for an income investor. From the time rates started to rise in 2020, dividend growth way outperformed the bond market and continues to outperform the bond market. Let's move on to commodities just from a big picture. After a bear market that lasted from 2008 through 2020, commodities started to rally. We consolidated during the Fed's tightening cycle, and as we pointed out over the last couple of months, commodities have once again started to rise in price. That's reflation. But on the other hand, while the Fed was tightening, people decided they wanted to exit their commodity positioning to put us with the lowest positioning in the market in several years. Commodities versus bonds consolidated during the Fed tightening cycle, commodities outperforming the aggregate bond index. Commodities relative to the equally weighted S&P started to rally in 2020, consolidated through the Fed tightening cycle, and 1, 2, 3 of the last 3 months working their way higher. So stocks attractive relative to bonds, commodities attractive to both against both bonds and stocks. So we rank probably commodities as one of the most attractive assets, equities as attractive, and fixed income continues to lag. So very difficult for a risk-averse investor, because when they look backwards, commodities are a scary place because, of course, it were tough from 2008 through 2020. And so positioning in bonds has been sort of fruitless so far since the beginning of this bear market. US dollar, I touch on it briefly. I think it's interesting. The one observation I'd make is that the US dollar peaked out when the US stock market bottomed. We've had a series of lower highs since then. We have had a pretty good rally in the US dollar through the course of the summer and early fall. And it's interesting to see commodities actually outperform during this period, because that's very unusual. Usually commodities do well when the US dollar is weakening. We are running into some resistance here, where we got to in March of last year, and where we broke down below the 100 to 200 day moving average back in November of 2022. So should the US dollar start backing off, I think that would add accelerant to the commodities. Okay, so as everybody knows, we don't have to be everywhere. We need to identify some key market leading themes and focus in those areas. We're always looking for change, new leadership to emerge, and old leadership, of course, to recede. And in the absence of leadership, have an ability to be in cash. So we're trying to be tactical about this, and we're using our two main models. We use a top-down model that helps to identify pockets of our investable universe where we can focus in areas where there are net inflows of capital. And then try and identify specific securities to use to express that view, looking for securities from a broad universe that are good getting better, where we see their fundamental characteristics improving in their income statement and their balance sheet, ideally accelerating, and see that along with relative price performance versus the market. The best companies should be relatively outperforming the market. Now, a very high percentage of return comes from getting the right asset class and the right sectors within that asset class. And then, of course, we can add value by finding the right securities. From a top-down perspective, we're always looking for areas of the market that are seeing expansion in breadth, where more and more stocks are participating in strength. That's a bull market. And when breadth starts to deteriorate, It doesn't mean everything will sell off. The first ones to roll over probably are the weakest. And if the selling picks up and hits more and more groups, then we have to recognize and be prepared to move to the sidelines. We don't add new positions when breadth is deteriorating. And I put that point because it's really important. When breadth is deteriorating, we tend to raise some cash. We'll stay in the positions that continue to work, but we don't put a lot of new money to work. So let's talk about where we are. As of a week ago, we highlighted that breadth in the NYSE and for equities globally and here in Canada, breadth had been contracting since about the beginning of August. Some of our shorter term indicators were acting a little bit better. Percent of stocks with a 50-day, percent of stocks trading with positive weekly price momentum, percent of stocks trading making new highs versus new lows, and percent of stocks trading above their 150-day moving average performing well. Now this week, things were a little bit sloppier, a little bit of weakness in percent of stocks over the 50-day, a little bit of weakness in percent of stocks above the 150-day, not enough to move the needle a lot, but we continue to be governed by the fact that breadth at the market level has been weak since the beginning of August. And so we have a little bit more cash than we would tend to have, cash or short-term bonds, and we wait. Now, one of the most interesting comments I've heard over time, which really tends to be true, is it never pays to short a quiet market. Volatility has continued to be very low. Intraday movement has been quite low. In other words, not a lot of daily volatility. So while breadth is not improving, it's not getting a lot worse either. And the groups that we're focused in continue to behave quite well. So we'll talk a little bit about that. We're going to focus a little bit on energy today because energy, I think, is a group that is underowned in general. Pension funds and ESG investors alike liquidated their energy holdings over the last number of years. It makes up a relatively small part of the S&P. It's about 5%, much bigger part of the Canadian market. But I would argue that the average portfolio manager doesn't have close to a market weight in energy. This is the XLE ETF. This is move higher through 2022 against a bear market in stocks. Through 2023, we consolidated through the Fed's tightening cycle. And like other commodity groups, started to rally going back to the early part of summer, and both on an absolute basis, moving higher daily, or against other parts of the market, relatively outperforming. So the XLE now is sitting at about the high for 2023 and very close to the high for late 2022. So this is performing really well. Now, part of it is that oil prices are moving higher. This is Brent crude working its way higher. It came out of a bear market that went on for many, many years, consolidated through the course of the Fed's tightening cycle, and now has started to march a little higher. We talked a little bit about Canadian natural resources. We're going to talk about it more today. But after a bear market that it went through from 2009 through 2020, and consolidation through the tightening cycle has started to work its way higher. We think it's very attractive with a 4% dividend. But I'm not sure everybody understands completely why we are so bullish on energy. And I think that it's going to be an important discussion. The XEG, which is the Canadian Producers Index, as a group has been moving higher. And the energy services companies have been moving higher since the early part of 2020. These are the drillers and the companies that keep the rigs going. So what do we think are the important macro factors here? Well, for one, we know that oil prices are trading at a 10-month high, but oil crude inventories are sitting at a 40-year low. So supply and demand rules. On August 23rd, we had 46 days of supply versus 92 days of supply in the Strategic Petroleum Reserve. And we know that President Biden steadily sold down the Strategic Petroleum Reserve to try to hold down price. Now, very difficult having sold off your Strategic Petroleum Reserve and have prices moving higher. We know that Saudi Arabia and Russia have been leading OPEC in production cuts to try and squeeze those that are short in the market and try to keep the market in balance. We know that the crude stockpiles are now at the lowest level since December, and we put together the cut in production from OPEC, the cut in supply from the SPR, and the slow production in North America, and it puts supply demand in a pretty tight picture. Now, forget just oil. If we include all products, crude, refined products, petrochemicals, biofuels, in millions of barrels, it has been a slow, steady slide, and we think that it's likely to continue. So what's causing that? Well, outside of those production cuts, we know that the energy industry has been held back in spending as far as new capital spending. Over many years, from 2014 through 2020, the energy index went down 90%. Boards of directors of companies suggested to the management groups that instead of spending money on capital spending, they should perhaps buy back shares, increase dividends, and return capital to shareholders. And when we look at the energy sector, capital spending has been very low, of course, relative to what we've seen in technology. Even to this week, the rig count in the US, despite the fact oil prices are high, rig count has continued to move lower. So all of that has been great for the companies. It's not great for the consumer. When we look at the net debt, companies have been paying down their debt pretty sharply. And that leaves them in a position to generate lots of cash. Now, I've asked Amit Joshi to jump on the call today with us. Amit is one of our portfolio analysts. He's focused in the energy space. It's a timely call. He's been at the Peters & Co. Energy Conference today. He's going to be there again tomorrow. And I thought maybe it'd be useful to bring him on for some insights because we're seeing some really interesting things going on. We got a fair bit of energy exposure. Amit, I don't know if you can see, but I've thrown up on the screen the chart that we talked about earlier that looks at free cash flow yield. Maybe just start with a few comments as to what you've been seeing at the conference so far.
Sure. Thanks so much for having me on the webcast, Dave. So like Dave mentioned, I've been spending most of my day today at the Peters & Co. Energy Conference. This is the 27th annual conference here in Toronto, and the Peters Energy Conference is one of the premier energy conferences in Toronto itself. I think the most striking aspect of the conference for me today was just the attendance level itself, probably more well attended than it has been in the past. Maybe not so surprising as we're seeing the crude price kind of approach $90 here, but not only was it well attended by investors, just the excitement that we're seeing in the management teams and the companies that are presenting at the conference itself. And a lot of that has to do with the comments that you've been making here, Dave, just in terms of the overall macro. We all know how tough the COVID pandemic was for the oil and gas space, and balance sheets that prior to the pandemic were probably over leveraged and had a lot of capital allocation going towards production were squeezed, and the whole space was in a dire situation. The silver lining coming out of the pandemic for the energy industry itself has just been the discipline on the balance sheet. And what we've seen in terms of efforts by the oil and gas companies in terms of paying down debt and really looking to maximize free cash flow. And the result of that is greater returns to shareholders, as you can see from the chart that you have up here. And that return of capital to shareholders in the form of dividend increases, share buybacks, and in some cases, special dividends as well.
So, Amit, if I could stop you there for a second, I had an interesting opportunity about 3 weeks ago. I spent the morning with a fellow named Satish Ray, who many may know as the just retired chief investment officer of OMERS. And OMERS, for those that don't know, had the #1 track record for a pension fund in the world last year. And he's a very, very bright guy. I I like to probably ask some leading questions. And one of my questions to him was, what do you think is the biggest shift in the world from a macro perspective over the last few years? And of course, people know we have our views. And the way he put it was this: he said, in 2020, when rates bottomed, we went from 40 years of the borrower being in control to what is a world where the lender is in control. So those that generate cash and don't need funding are likely to lead from a market perspective. And, when I pressed him on it, one of the things that he highlighted was he was quite bullish on Canadian resource producing, cash flow generating companies. So how does that apply against this universe of companies looking at this chart?
Yeah, that's an excellent question, and I think that's right in line with Satish's thinking, in a sense that these companies have done the tough work of paying down their debt substantially. Prior to the pandemic, being more than 3 times leverage in terms of net debt to EBITDA. Many of these companies have reduced that debt down to 1 times of EBITDA. So they're just generating a ton of free cash flow, given that, one, they've been paying down debt, and secondly, there's been a lot more discipline on allocating capital to production as well. Whereas prior to the pandemic, we would have seen a higher percentage of capital being deployed towards production growth. Now it's much more modest, and be that ESG kind of pressures, or more pressure from governments trying to move to green energy. But you're looking at growth rates now that are very modest, between 4 to 6% on an annual production basis. And what that's allowing for is, like you said, cash is king, and for these companies to build the coffers, pay down debt, and then return that cash to shareholders in the form of dividends and share buybacks.
So when we look at this column, free cash flow yield on the left, and some of these companies generating, upwards of 20 to 30% free cash flow yields, just explain what that means, in real terms.
Yeah, definitely. It's a metric in terms of the generation of free cash flow, to the percent of the share price itself, in terms of a share price divided by the share price itself. So they're just generating a lot of free cash flow that they have at the end of the day, after paying for maintenance, after paying for growth capex, that they have at the end of the day, to return to shareholders or to reinvest into the business.
So when
And
we
as
see
I
a
mentioned,
company like Tourmaline, where it's got virtually no debt but generating 20% cash, and
correct.
at this point only paying a 1.5% dividend, what can that mean for share buybacks and dividend growth?
Yeah, so that's a really interesting point. When you look at Tourmaline and you see a dividend yield of 1.5%, it's slightly misleading. What Tourmaline has been doing is paying special dividends. They've actually paid 7 special dividends since the fourth quarter of 2021. So when you actually look at the trailing 12-month dividend yield, it's closer to, I believe, 14%, which is massive.
So the
And
opportunity for these companies to grow their dividends, it strikes me as really something. And I threw this chart up a couple of weeks ago, talking about how energy, since the spring, on a relative basis, really has started to lead all parts of the market, including large cap growth, which really destroyed everything in the beginning of the year. This is, I think, probably something that's relatively early stage. And when we look at the market internals, we know in the energy category, virtually 96% of companies in the energy space are trading above their 50-day moving average, meaning everything is trending positive. Companies, over 90% of companies, are trading above their 200-day moving averages, which is, a different far cry from what we're seeing in some of these other sectors, where the percent of stocks trading above their 50-day moving averages, 30, 40, 50%. So maybe, and we talked about a few companies today that we thought maybe might be worth highlighting, but I'll put CNQ up at the beginning, and how it relates to these themes, and maybe we can talk through a couple of these names.
Sure, definitely. Canadian Natural Resources is one of those companies that really hits all the characteristics that we look for. A very strong leadership team that has a high level of operational excellence, and the asset base is long life, low decline assets, meaning they don't have to go out and look for more oil. They don't have to put as much of capital towards exploration. And they just have long life assets that they can continue to produce within the company itself. Strong financial flexibility. The company at the end of Q2 sat on 12 billion of net debt. There's line of sight that will be reduced down to 10 billion by the start of 2024. And at that point, we'll see 100% of free cash flow go towards shareholder returns, be it dividend increases and share buybacks. So lots of financial flexibility, strong management team, and operational excellence.
So for a company with a 4% dividend to start with and a dividend growth rate of over 30%, you know, that's a pretty potent combination when you don't have a lot of capital spending that you have to do. We'll go beyond CNQ and throw up Tourmaline. We talked briefly about Tourmaline a moment ago. On each of these charts, you can see how in blue at the bottom, this is relative strength versus the S&P. All of these companies in April and May started to relatively outperform the market. And, you know, we're very close to relative strength new highs, despite the fact that here we are, you know, middle of September when people are kind of nervous. What are your thoughts on Tourmaline?
Yeah, Dave, in terms of Tourmaline, it's a lot of the same characteristics that we like about CNQ, just in more of a gas-weighted company itself. A very strong management team, great assets, a very long reserve life, and a pristine balance sheet. Like you mentioned earlier, essentially no debt on the balance sheet for Tourmaline. They've been paying that down aggressively and are now returning about 100% of free cash flow to shareholders in terms of the base dividend itself, share buybacks, as well as special dividends. As I mentioned, they've paid 7 special dividends since the fourth quarter of 2021. So, you know, in terms of compounding dividend growth, this has been the poster boy.
So, you know, if I move back 5 years ago, the natural gas companies were in a world of hurt. You know, what happened from a consolidation perspective that have put these companies into a better spot, and what helps to get some of this gas out?
Yeah, you know what? That's a really, really good question. And, you know, like you said earlier, cash is king. Tourmaline is one of those companies that has operational excellence, had a decent balance sheet going into the pandemic, and has an even better balance sheet now. So what they were able to do, you know, in the during the pandemic is acquire some assets at really good asset prices and kind of build out their portfolio. And now it's harvest mode. It's about reaping the rewards of that hard work that they've done when things look tough, and just redeploying that back to shareholders in terms of shareholder returns. The interesting part of the story for Tourmaline is their exposure to the international markets through LNG, which will get them a stronger natural gas price as they sell into the international market. So that's going to be a growing piece of the story going forward for Tourmaline.
Right, because historically gas was really locked in Western Canada, and the capacity to get it out was really constrained, and that story is changing, isn't it?
That's correct. Yeah, in terms of all the LNG buildouts, LNG Canada, Tourmaline previously signed a deal with Cheniere for some of their production to go there and head out to the international markets, specifically the Asian markets, which have been giving a stronger natural gas price.
Yeah, yeah, very, very interesting. Okay, I've thrown ARC up on the screen. Same thing. We can see a rising relative strength line since January. So one of the early outperformers. And, you know, not that long ago, took out the highs from 2022 when it traded through 20.5. We're now sitting at 21.40. Really, like today is sort of a new high close from a weekly basis. What are your thoughts here?
Yeah, I'm going to sound a bit like a broken record, but it's a lot of the same characteristics. It's a strong management team. It's good assets with long life, low decline rates. ARC has a mix of gas and oil, and just a combination of paying down debt and returning cash to shareholders through dividends, share buybacks. Looks very, very interesting. They also have committed to committed to 100% of the free cash flow going back to shareholders in 2023. So as they continue to harvest their assets, all of that is coming back to shareholders. They've also targeted about 25% of their production to go to LNG as well. So they will be getting the stronger international prices for that portion of their production.
It's really interesting. I mean, I guess we use these as poster children for the types of things that we want to own in a world of rising interest rates and a world where maybe inflation is going to be a little stickier than people thought. Certainly, some of the inflation that came out of the system was energy prices moving lower. That is not the case any longer, and we're seeing really a lot of companies that are, especially the well-managed ones. And I've got Topaz on the screen here too. Sort of all behaving the same way. So, Emmett, I really appreciate you jumping on. I know you're back at the conference tomorrow. I'm sure you come back with more insights. This is a part of the portfolio that has been growing from a weightings perspective, and we do have lots of exposure across the producers and the service companies. And I think precision drilling is a newer ad that's in our energy services portfolio. So thanks so much for jumping on. I want to highlight this story in commodities is not just a carbon-based energy. The uranium-producing companies have been performing, remarkably well. We talked a number of weeks ago about Cameco breaking out of the range it was in going back to 2011. And look at this move we've had in the last month. We've moved from $40 to just over $51. And it's not the only one in the group behaving that way. When we look at our weights, we continue to have a below market weight in tech. The companies that we own are largely cash flow generating companies that do have dividend growth. We think that's by far the most attractive part of that market. Our financials exposure, is down a little bit. It's about 17%. I've been asked by a number of people about the banks. Our bank exposure is really quite low at this point. JP Morgan would be our biggest holding, and TD in Canada. But the insurance companies really are where our weightings are, and they do benefit from rising interest rates and offsetting the liabilities that they have in the future. Energy just continues to grow as a weight. And I think that's sort of key. The industrials continue to be an overweight. That again, sort of a reflationary asset. Companies that have an ability to set price. You can see that our bond positions, have grown a little bit. Again, they're short-term bonds we're using as a replacement for cash. We don't have long-term bonds. We have positions that we're holding that could be deployed into dividend growth securities as our breadth models improve and our cash weight's about 7%. Most portfolios have about 15% between short-term bonds and cash. And we're getting paid, the interest payment there. We don't have a lot of interest rate risk. We still have about a 2 times market weight materials, and we continue to be really underweight the high dividend paying companies with low economic sensitivity and low growth. You would think that if your concern was recession, you'd want to own a bunch of utilities and REITs and consumer staples and telecom. They just are not performing, and they continue to be weak. Consumer discretionary, I think, is a group that we have a really significant underweight in as well, because if there is risk due to higher interest rates, that's a group that maybe we see a little bit less spending. And healthcare tends also to be defensive, and we have a really underweight position here. So I don't like to compare us to an index because our returns come at different times usually than indices do. We've had quite a good go relative to TSX and the S&P and the bond indices since March of last year, when these themes all started to lift. And I think the most important core characteristic that we're looking for across portfolios, not just in our income mandate, is total return between price and getting some cash generation from the portfolio. Now, I've highlighted this before. We know that during periods of falling interest rates, stocks and bonds gave about the same return. So the early 1900s until late 1940s and 1980s through the end of this most recent decade, stocks and bonds had sort of similar returns. When interest rates started to rise, we've highlighted that stocks way outperformed bonds. And, we know that this is inflation in the period through the 1950s and 60s. It was higher in fits and starts, higher right after the war, then came down. But stocks really performed well in that 15 years. And if we look at the Dow, this was the move, right? There was lots of little corrections along the way, but a really good bull market. In this period from 1950 through 1966, as rates were going higher, stocks went up 15% a year. And bonds basically gave an inflation return because prices were falling. You got the coupon, but you were losing money. Now, I talked about this a lot, and the fact that in that period, the dividend growers were the leadership. I saw an interesting illustration this week, which looked at, not the exact same period of time, but looked at all the periods of rising interest rates versus all the periods with falling interest rates. And what happened? Now, we know that since 1980, we've been dominated by falling interest rates, but there were some periods where rates rose. And I continue to hear concern that how can stocks go higher if rates are going higher? So this is from 1962 to the present. And in periods where rates were rising, bond prices fell, right? Simple math. In periods where rates were falling, bond prices rallied. Now let's look at periods where interest rates were falling, stocks went up. But in periods where rates were rising, stocks also went up 10.5% a year. But the thing I think is really important is that in periods where rates were rising, a 60-40 portfolio of stocks and bonds gave only a 5.5% rate of return versus when rates were falling, 14%. Our view is that the period of a old-fashioned balanced 60% stock, 40% bond portfolio is going to be limited going forward. And we want to focus on the equity piece and specifically high dividend growth. Now, in our income strategy, if we take those same periods, and this is just since we've been running income money, all the periods where rates were rising on a 10-year, obviously a hard period to make money in fixed income. But in those periods, our income strategy tended to do well. If we look at all the various periods where rates were rising, these are date ranges along the top. This is the amount that rates rose. This is what happened to bond prices. These were the returns we got in that tactical income portfolio. And in particular, since September of 2020 through July 31st of 2023, income portfolio generating positive returns, where 3 years of difficult returns for bonds have yielded negative returns. So why is that? It's because if you're getting a decent dividend, but your dividend growth is 15 to 20%, then you can offset the impact of those rising rates. So let's just take a near-term period of time. Since March the 15th through today, the income portfolios had total return of about 7.6%. Now that's versus a high dividend paying ETF at about 3%, a Canadian high dividend paying portfolio down 0.2%, the US aggregate bond index over that same period, a total return of -2%, the Canadian 10-year bond down 8% since March 15th, and the US long end of the bond market down 10%. So we think this is the beginning of relative outperformance for high dividend paying stocks for this next economic cycle. Now, a year ago in September, we said, look, market's down 25%, and the market's been down sharply over 9 months. 6 months out and 1 year out, it tends to be markets are doing much better. And certainly a year out, markets are doing much better, in this case, like they had in other periods. We highlighted recently that when the market was up more than 10% going into August since 1954, and you had a difficult August where the market pulled back a little, it tended to be September was positive. Well, that remains to be seen. But in 100% of those cases, the market was up between September and December. We think dividend growth is going to continue to lead this market. And for those that are concerned about recession, where a year ago, 98% of economists believed we were headed for recession, today 22% of economists think we're headed to recession. So those are opinions and those are statistics. We like to look at the internals of the market and look for signs that there's a problem. Volatility has been falling now for a year. No sign of major stress in the system here. Credit spreads, or the excess return that a bond investor is demanding to take credit risk from an investment grade issuer or a high yield issuer, have both been falling. There's no sign of stress in the bond market. Now, that doesn't mean it can't change. And we got to watch every day. We got to make sure that the themes we're focused in are the right themes. But it continues to look like October of last year was the low. And we all need to be positioned to take advantage of what comes in the following 3 or 4 years, which is where we're going to make returns. If some of these themes start to falter, we will get more defensive. We got a history of doing that. But as we move through September into October, if the market remains quiet or sideways or listless, it doesn't make sense to go do a lot of selling, because ultimately it doesn't make sense to short a quiet market. And we'll continue to update you. So with that, Pamela, if there's any questions, certainly happy to answer them.
Hey, Dave, thanks so much. Yeah, we have one question here from Tara. Tara loved the review on our energy position. So thanks again, Amit, for joining us this afternoon. She wants to know, David, energy dividend payers, should she still continue to add those to her portfolio?
Yeah, look, I really think, let me just see if I can share something here. So as a group, if we were to take an ETF like GUNR, GUNR is an ETF that has a basket of cash flow generating resource producers. Let me see if I can throw it up this way. Okay, so it's paying a yield of 3.7%. Dividend growth rate's 23%. You get a basket of energy companies and other upstream resource producers. I think that this is kind of attractive and relatively early stage. I think if you, certainly our income portfolio is a great place to start. But that list of companies all are growing their dividends, and we're likely to have over 20% dividend growth. And again, if we're just coming out of a major correction, this is likely to go on for a period of years. So in our history at Barometer, our focus has always been recognize structural shifts in the market that can lead to a long period of revaluation. So when the tech bull market was over in 2000, we moved on and we moved to a tactical income strategy, trying to find companies with a rising ability to pay an income. And we had a great 10 years following that period. And when energy started to do well after 2009, due to fracking, again, it was a period where you got 5 years of a run. I think we're in the very early stages of this next cycle. And I think there's a mountain of money that's hiding in the bond market, looking for safety and income. And I think that now 3 years into losses, people have got to be starting to feel frustrated. And they're going to look for an alternative to that. And I think they're going to turn to dividend growth securities. And I think we're in the early stages of a bull market in some of these companies.
Thanks so much, David. Well, that concludes the questions we've received this afternoon. So as always, I will leave you with the final word. Thanks again, Amit, for joining us.
Yeah, look, our job sometimes is a difficult one because we have to get portfolios positioned for the next economic cycle. And the next economic cycle is rarely like the last economic cycle. So when people want to jump right back into the stuff that led the last cycle, like they did in January, February, and March in tech, it was an unpopular message to deliver that we want to be focused in sectors that have been horrible for 10 years. But that's really the job. We want to be there before it's consensus. Now, people are slowly figuring out. Amit said, attendance at this year's Peter conference is a much greater attendance. Those are the professional investors coming to learn. Our view is that it will be a long time before Main Street is really focused on these companies. So we think that there's an opportunity. Our job is to take advantage of them, to get focused on the best companies, and then sit and let the market do the work. It was a real tough year through 2022. One of our big focuses in 2021 was focusing on launching our a global music royalties fund, which again was an asset that people didn't understand. But in a year where almost no assets were up, it was up 11.5% in 2022 and performing well again in 2023. I think that's a multi-year theme as well. So anyway, if you'd like to have a conversation, please give us a call. Happy to answer any questions that you have. We appreciate everybody tuning in. And as we move through the fall, we'll continue to update weekly. And if you got questions in between, don't hesitate to shoot us an email or send us a text, and we'll jump on. And in between, if you want to watch, I'm posting pretty regularly on @Barometer CA on Twitter. Hope you guys have a great week. Thanks, Pamela.